Good morning. Thank you for coming, and thank you for inviting me, Professor Papadimitriou. So, I'm Nikos. I run Bloomberg's bureau here in Athens. And in this first panel, we're going to talk about the ECB, which an institution which has been praised by some as savior of the euro area and accused by others as for not doing enough to boost growth in the euro area. Likely, Bloomberg reporters don't have to express views and their views about what's true and what's accurate and what's not accurate, an accurate assessment of monetary policy. But our speakers today have their views, and without further ado, I'm going to start with Emilios Avgouleas, Chair of International Banking Law and Finance at the University of Edinburgh.
And as always, it's a pleasure to be here. In reading the heading of this session, I was put into deep thought as to what I could contribute as a professor of law and economics. So the way I have approached my topic is from the viewpoint of the internal market, how the internal market has interacted with the monetary union and monetary policy. So the objectives of my talk today is to highlight the key role of capital movements in causing structural weaknesses in an imperfect monetary union like the European Monetary Union, to explain the key role that the freedom of capital, which is entrenched in the EU Treaty, is playing in generating, in enhancing and deepening the monetary union, but at the same time generating structural weaknesses, evaluate the risks of an incomplete monetary union for the continuation of the single market, discuss possible restrictions that renegade member states could consider in a very economic theory mode, discuss the possibility or impossibility of a member state imposing those restrictions and consider their possible legality, and propose alternatives to save the internal market from the deleterious fragmentation that an incomplete monetary union brings about. The first thing that one needs to do in considering the internal market is to take into account the key role that the free movement of capital is playing in deepening the monetary union and making it functional. Without free movements of capital, the monetary union would have been nothing but a wish list. The free movement of capital, which is entrenched into the fabric and the DNA of the European Union since the First Treaty of Rome, has never been clearly defined, even though it's the cornerstone of the internal market. Normally, we define it by reference to a liberalization directive of 1988, which more or less incorporates the IMF nomenclature on what free movements of capital mean. The nomenclature, the directives nomenclature, which, as I've said, reflects the interpretation of the freedom by the IMF, includes long-term, as we can see, long-term flows, foreign direct investments, capital market investment, reflects real estate investment, reflects securities investments, short-term credit flows, and all kinds of other financial flows between financial institutions or financial institutions, corporations, or individuals. Now, it's not really accurate to say that this is an absolute freedom, because there are a number of restrictions that are recognized by European law. The first restriction is that a country can indeed restrict flows if there is a financial stability crisis, the so-called prudential carve-out. Then there is the safeguard principle for the member states which are not members of the European Monetary Union. That means that you can restrict payments if there is a balance of payments, if there is a current account crisis. Then, of course, this is still intra-EU capital flows are still flows between different countries, and money laundering laws do apply. And there are restrictions in the general interest, which the meaning of which I will consider later on in my presentation. And of course, there are de facto restrictions because the taxation regimes for capital are not harmonized within the EU or within the monetary union, and there are actual restrictions on the ground because consumer contracts are always regulated by the law of the place or, where the consumer resides, which means that you can easily offer the same service to 28 citizens of the EU member states, and that transaction be regulated at the level of consumer protection by 28 different legal systems. Now, as I've said, the EU is taking this maximalistic view of the, and the EU Court, of course, the European Court of Justice, this maximalistic view of what is freedom of capital, and includes both long-term and short-term flows. These, of course, this maximalistic view, however, has no valid economic rationale, as in some cases the two kinds of capital flows are easily discernible, easily divisible. And in the second case are especially creditor flights in order to avoid the bail-in, or that's ex ante, not ex post, because ex post you can have the prudential carve-out, and to avoid the restrictive tax regime. And I'm sure the people of Greece are very, very familiar with such flights, because this is exactly what happened post-August 2009. Now, the prudential carve-out, as we can see, is rather limited, and will be even more limited in the future because banking supervision and resolution in the European Monetary Union has been centralized by means of the institutions of the European Banking Union, namely the single supervisory mechanism, which is operated by the European Central Bank, and the single resolution mechanism. So if a country wants to invoke the prudential carve-out in order to stop a capital flight, it will be too late, because it has to be ex post facto once a financial stability event has been declared. Now, why the freedom of capital is so important for a monetary union has always been seen as the cornerstone of the final step for the completion of the internal market, which of course was the paramount objective of the Treaty of Rome. It's unthinkable to have a common currency union where you can have capital restrictions. Lack of capital restrictions adds to the credibility of the currency as an international reserve currency, and thus to the status, prestige, and global importance of the euro. And of course, somewhere there we have the neoliberal view emerging, which told us well in the past, as a matter of fact, that capital flows are all the same. And capital flows are all the same because the Homo economicus is obviously immune to panics or any kind of emotion, including being part of a bubble or an irrational exuberance event. However, The whole intellectual and ideological construction presented 3 flaws and was covered by half-truth. The 3 flaws are that short-term capital flows are as beneficial as long-term capital flows. As I will explain later in my presentation, they are not. Secondly, it was assumed that in a currency union there are no runs on member states as stronger members preserve the value of the currency, which is true, but there are runs on member states' financial systems once confidence has evaporated in the economy of the member state that is afflicted by a macroeconomic shock. Then the currency union itself will alleviate competitiveness asymmetries because of factor mobility, especially labor mobility. If you see the OECD's especially output on how to make a complete monetary union work, the accent is always on factor mobility and labor flexibility, which is, of course, possibly an exaggerated approach to how to resolve structural problems in a monetary union, because there are inherent limitations in the movement of workers within the monetary union, the most important being linguistic and cultural differences. And the half-truth is that there can be no balance of payments crisis in the sense in the sense of those that have incurred between fixed exchange rate systems within the monetary union. And as a result, exchange rate shocks have disappeared. In reality, what we really have is that the fiscal position of, in a monetary union, when the fiscal position of a country deteriorates, mostly due to deflationary effects of an internal devaluation, like the one that is going on in Greece right now, investors are gripped by fear, leading to a collective crisis confidence. There is a run on the bonds, and there is a liquidity squeeze in the country which cannot borrow at affordable interest rates. This is a quote from the leading monetary economist in Europe, Paul de Grove, and the thinking that follows from that is that in such a case, the country in question will have, as I believe, every incentive to resort to semi-compulsory internal lending, which may only be possible if capital restrictions are reinstated. And here we enter the realm of economics and we start hypothesize. Another accurate representation of what happens in the ground, what are the real economic conditions in the Union, is that the Eurozone crisis, with the exception of Greece, was not the product of a public debt crisis, was the product of unsustainable private debt accumulations due to unrestricted flows of capital. These probably triggered a Minsky moment. I think we are in the right place, in the right conference to discuss about a Minsky moment. And serving household and bank and corporate debt eventually became unsustainable. The prior accumulation of private debt in the Eurozone generated a number of uncontrollable booms and bubbles, especially in the real estate sector. Principal examples, Spain, Portugal to some extent, Ireland, and to some extent Greece. And here is how government debt, which is the pink line, developed during the years of the monetary union and up to the 2008 crisis. As you can see, there was, as a matter of fact, a gradual reduction in public debt in the Union, with the exception of Greece, and especially countries like Ireland or Spain were among the poster boys of fiscal prudence in the world, especially Ireland, was a remarkable example of economic growth and fiscal prudence. But of course, then the banking crisis came, and the banking crisis came because trade surpluses had been recycled as flows that fueled real estate bubbles. Here is another slide that shows you how they are both lifted by the European Commission database. I assume they are credible and reliable, but they are not products of my research. And this slide shows how bank and corporate liabilities were gradually higher and higher, started increasing in the Eurozone in the post-2000 period when interest rates become lower and lower because especially borrowing rates converge throughout the monetary union. But what happens next is that a country that is suffering from the dynamics of a boom and bust situation has no internal stabilizers because it cannot devalue its currency. What it has to do is decrease the cost of production. And that's, of course, a very, very painful remedy. And to be honest with you, if we exit the chic premises of this conference hall or of Central Athens and we move around to the neighborhoods, we are going to witness untold poverty. Poverty that we only meet in African countries. So the effects of the structural adjustment in Greece through deflation have been beyond painful. They are, as a matter of fact, the social impact is, as a matter of fact, as far as I'm concerned, underreported. So, and you do all that probably for nothing because the other member states are not importing due to austerity policies. And here is the main problem. The way current account deficits and surpluses developed in the European Monetary Union in the post-2000 and the post-1999 period, even though Greece became a full member of the European Monetary Union in January 2001. So it's an issue of public indebtedness and current account deficits rather than fiscal profligacy and high and unsustainable levels of public indebtedness, again with the exception of Greece, which also suffered from massive governance weaknesses. And then there is no investment, there is no stimulus to boost productivity because of the same austerity policies. And there is no common fiscal governance mechanism. So fiscal divergences in an incomplete currency union normally worsen instead of improving because current account deficits worsen. So, what would the state in question eventually do in order to protect itself since no other stabilizing mechanism is available to it? Well, we'll think that the IMF, in its latest guidance to its staff in 2013, says that as part of liberalizing capital flows, short-term restrictions on capital flows are very acceptable, especially if they are associated, if they are followed by a macroeconomic adjustment program. So, according to the IMF, of all organizations, short-term capital flows when you face a macroeconomic shock are beneficial. So, in the absence of a common European treasury to absorb national fiscal shocks and an absence of a harmonized fiscal governance environment, our member state will look into short-term capital flows and it will be right to do so because this will be highly destabilizing, especially in the face of a macroeconomic shock, because money will be flowing out of the country like the flooding in the Noah's parable in the Bible. And these outflows, of course, can cause panic, undermine all confidence in the capital exporting country's economy, and they can undermine systemic stability way before you can invoke the prudential carve-out. So, can we have a restriction on the short-term flows of capital based on the European law? And the answer is that all fundamental freedoms are subject to this general exemption that is called in the general interest. And there are requirements to invoke an exemption in the general interest. The restriction must be non-discriminatory. Also a qualification that the IMF is stressing in its guidance on capital flows, on capital management measures, as they call them, to its staff. So no restriction between foreign and local exporters of capital. They must be justified in the general interest and perhaps a macroeconomic shock. General interests do not come better than a macroeconomic shock, as in the absence of other stabilizers. And they must be suitable for securing the attainment of the objective, and of course they must be proportionate. So how could we build a restriction on short-term capital flows on the basis of the general interest exemption? First, it must be a state that objectively faces a fiscal crisis due to a macroeconomic shock. It doesn't get more objective than entering the excessive budget deficit procedure under the European Growth and Stability Pact. And of course, if you face a macroeconomic shock, major financial stability threats start building up, even though you are very far away from being able to invoke the prudential carve-out. Secondly, the measures must be provisional and thus proportionate, instead of cancelling the freedom of capital, which is, as I said, embedded in the DNA of the European internal market and the European Monetary Union. Also, condition 3, the restrictions should not extend to commercial payments or trade payments, to FDI commitments, or any other prior payment if you have to pay the fees of your child that is studying abroad. There should be no such restrictions. So you just focus on loose money that's probably untaxed money. Should be no discrimination between foreign and domestic exporters of capital, and there must be legal certainty that the measures will be repealed as soon as the macroeconomic shock disappears. That means exit from the excessive budget deficit procedure. The obvious argument that the European lawyer would ask is, the obvious question that the European lawyer would ask here is, why not widening instead the prudential carve-out? Well, if you follow the prudential carve-out rule without declaring a bail-in first, you will probably trigger a bail-in because you will trigger a crisis of confidence in the banking system. Also, it's not in the prerogative of monetary union member states, of the Eurozone member states, to invoke a financial stability event. The supervision of the banking sector in the monetary union has been centralized, and responsibility has moved to the central bank, to the European Central Bank, and so has resolution through the single resolution mechanism. These, of course, are regulators that will be very unwilling to invoke the prudential carve-out. They would be very unwilling to declare financial stability events and give grounds for the member state to invoke the prudential carve-outs. As I said, will intensify panic, and also, if they ever do so, it will be too late because it's their interest not to show that they were not competent supervisors. So, if it is temporary and transparent and non-discriminatory and proportionate, what a restriction like that would do? Well, it will apply the brakes on panic outflows, exactly what Greece and to some extent Spain and Italy experienced in various periods until Draghi's will do whatever it takes, which I thought was the best thing that has happened in European history in the 2000s. Obviously, it's the only mechanism available to contain the impact of internal exchange rate differentiations within the monetary union. There is nothing else there. So, what are we going to do in order to dissuade? And of course, it will be ineffective if there is no fiscal restructuring plan. But of course, if you enter the excessive budget deficit procedure, a fiscal restructuring plan follows. So what are we going to do in order to dissuade a hypothetical renegade state from invoking a restriction on short-term capital flows in the general interest? Especially because any capital restrictions, including those that were invoked by the Republic of Cyprus following the bail-in of its banks in 2013, grossly undermine the coherence of the monetary union and the credibility of the euro. Well, the solutions are a common European monetary union treasury and limited debt mutualization. And since I'm Greek, what do I mean by limited debt mutualization? Do I mean that the Germans should tomorrow assume Greek indebtedness and the fact that Greece has suffered for many, many decades, as a matter of fact, from structural governance weaknesses? No, I do not mean that at all. Debt mutualization must be on the basis of strict rules and must be, first of all, partial in order to ameliorate, to eliminate moral hazard. I think a 60% debt mutualization in the vicinity of 60% of GDP should be acceptable because that's one of the Maastricht entry criteria in any case. Obviously, if you resort to debt mutualization, somebody will be paying more for the cost of borrowing for the surplus countries will increase and the cost of borrowing for the deficit countries will decrease. And we should have an internal payments mechanism to rebalance this injustice. And I think the internal payment mechanism that can redress this injustice is by the debtor countries, the deficit countries, to assign whatever is their share in the ECB's senior edge or the general ECB profit to the surplus countries that will obviously have to pay a higher interest rate for their public borrowing. Naturally, it is an internal transfer mechanism, as I explained, but there are benefits. Another benefit that's not mentioned in the slides, but comes from recent IMF research, is that if you have non-defaultable bonds, the interest rate on those non-defaultable bonds collapses, which means that at the end of the day, and of course, the IMF evidence is experimental and not empirical, but it's possible that at the end of the day, everybody will be better off because creditors will take into account that the default option does not exist in the new mutually issued bonds. Now, obviously, a Debt mutualization will also help with the interest rate differential bubbles and so on, but also will make the banking union more credible. The banking union is much reliable on effective resolution, which is entirely dependent, as it seems, on the basis of the Bank Recovery and Resolution Directive, on effective bail-ins. However, in a recent paper, myself and Charles Goodhart have suggested that the benefits of bail-ins may be exaggerated. Perhaps it will work, perhaps it's no more than a bandwagon, even though it did work in Cyprus. But Cyprus was an anomaly because Cyprus had a very large share of foreign depositors. Foreign creditors took the cost of the Cypriot bank bail-ins as much as local creditors. In other scenarios, it's possible that bail-ins may trigger contagion and credit of flight, even though it didn't happen in Cyprus. At the very least, we argue, bail-ins will increase the cost of bank refinancing. But if that's the case, and if member states have no real confidence in the effectiveness of the pan-European resolution mechanisms, the next step is ring fence. Ask for subsidiarization, exactly what a member state that is not part of the monetary union, the United Kingdom, is doing with most European banks these days. Subsidiarization, however, like capital restrictions, is yet another threat to the coherence and orderly function of the internal market. Conclusion. Massive trade imbalances may force a hypothetical renegade monetary union member state to resort to short-term capital restrictions. Even though that's going to be the mother of all legal battles, on the face of it, such restrictions may probably be legal and not held to be in violation of the EU treaty, even though they do cause serious fragmentation in the internal market, a serious rupture in the edifice of the internal market. A renegade member state might also start differentiating its tax regime in a way that tax differentiation becomes a barrier to trade within the internal market. The best mechanism is, of course, massive differentials in the VAT. So, if we stand still, sooner or later we are going to face a slow and long-drawn process of disintegration of the internal market within a currency union, unless we proceed to mutualize member states' debt in the way that I have explained, and probably look to measures to establish, if not a common monetary union treasury, at least coherent fiscal governance mechanisms that would amount to a single monetary union treasury. Thank you very much.
Thank you for sticking to the 25 minutes, right? So, Lex Hoogduin, Professor of Complexity and Uncertainty at the University of Groningen, is next.
Good morning, ladies and gentlemen. First of all, I would like to thank the organizers of this conference for inviting me to be here. It's really a great pleasure for several reasons. First of all, to be able to visit Greece, although only it's a very short visit. Secondly, because I really like, let's say, the approach taken and the work done by the Levy Institute in the tradition of Minsky, and also the work in the tradition of what is also called modern money theory. And last, certainly not least, because it's an opportunity to see since quite some time to meet Jan Kregel, who in the early 1980s was professor in Groningen in the Netherlands, and he was my PhD supervisor. and really made me think very differently about economics and economic policy. Although that may not be reflected in the comments I'll make today, because perhaps in some respects I will be kind of advocate devil. What I would like to do is, first of all, it was already clear in the first presentation and also in the introduction that the ECB is looked at and perceived as a solver of the euro crisis, or at least the ECB is there to buy time for other parties, the governments in particular, to come up with a solution. I will take a slightly different perspective this morning. I will do three things. I will first very briefly recapitulate the ECB's mandate in the EU treaty and its statutes, because I think in thinking about what has to be done, we have to really build and continue to build on the Maastricht Treaty. Now, I immediately tell you that I'm biased. I was at the ECB as an advisor to Wim Duisenberg when the ECB was established. So I was involved in the process, and you have to take that into account. So, but I will briefly summarize the ECB's mandate, and I will go into where do we stand now if you compare that to the ECB's mandate and what can be the road ahead. First of all, the policy objective of the ECB is given by the Maastricht Treaty. As we all know, its primary objective is to maintain price stability, and the ECB should support economic policies of the EU without prejudice to price stability. So price stability is the overriding objective. In the treaty itself, the definition of price stability is not mentioned. So the objective price stability has been defined by the ECB and has been further clarified over time. And as we speak, price stability is defined as an increase of the harmonized index of consumer prices, so the consumer price index for the euro area as a whole, of close to but below 2%. And it's always added that price stability is to be maintained in the medium term. There's a very subtle element in this definition, because it is a definition, and I will not elaborate on that, but explicitly from the beginning, the ECB didn't want to be seen as an inflation targeter. So you will never see in the documents that this definition is also something that has to be very closely targeted, and that's not totally without meaning. Initially, there was also a lot of discussion about whether the ECB had a symmetric objective, whether it disliked inflation as much as deflation, or whether the main focus was on avoiding inflation. And there has been a lot of effort by the ECB to explain that the definition indeed is meant to be symmetric. So the ECB doesn't like inflation, but it certainly also doesn't like deflation. Then, of course, the participating countries in the EMU have to meet the so-called convergence criteria on a sustainable basis. Otherwise, there was no sound basis for the euro and a common monetary policy. So the convergence criteria are really the rules of the game. The treaty also stipulates that the euro area is a market economy. And you could say that if you look at how the ECB's work developed, that the analytical framework underlying monetary policy is the so-called New Keynesian model, which I will not go into in great detail, but let me just mention a couple of examples that are, a couple of elements that are important. Money is supposed to be neutral in the medium to long run, so that means that monetary policy can only affect inflation over that horizon, and it cannot sustainably affect real variables. So the ECB, in its own view and in its own framework, is unable to affect the growth rate, the unemployment rate over the longer term. And in several instances over the past what is it, 15 years or so, the ECB has all the time emphasized that its best contribution to growth is to maintain price stability, to provide a stable environment. In the short to medium term, the ECB thinks it can influence real variables due to frictions, so-called frictions in markets. So too little flexibility in markets means that monetary policy has short to medium real effects. Market flexibility in this model is seen as a good thing. It improves welfare and enhances the transmission of monetary policy. So if you go back, let's say, to the beginning of the ECB, there's a monthly press conference of the ECB president. I don't think there's any exception in all those press conferences. At the end, the ECB always states that structural reforms are necessary to make markets function better. I think it's overdone to stress that all the time, but if you are in doubt that the ECB thinks that market flexibility is seen as a good thing, just go through these introductory statements of the president. Policy instrument is the short-term interest rate, a very short-term interest rate, the overnight interest rate, and there is in the setup a clear operational framework with as little as possible interference of the ECB in financial markets and markets in general, based on the philosophy that markets function well and should only be helped to function better, not by interfering in the direct functioning of the markets. Now, that is very briefly and very incomplete, is the kind of framework that is in the Maastricht Treaty and that follows from the Maastricht Treaty. And if you see where we stand now, the first thing I think that you should know that framework lies in tatters. We have moved into what I would call a non-regime. And that was triggered by two things. And these two things summarize my diagnosis of what this crisis is, where we are in the euro area. And basically, I think it's very important, I have no time to elaborate on that, but I think it's very important to make a distinction between, on the one hand, the broader financial crisis of at least the advanced economies that we have since 2007, 2008, and what I would call the euro crisis in a narrower sense. Because I think the deterioration of the framework has been triggered by two things. First of all, and it's an arbitrary order. I don't say that the first one is the most important one. Probably it's the other way around in terms of importance. But the first thing is that there was non-compliance with the convergence criteria. Perhaps at the beginning already in some cases, but certainly during the process thereafter, the criteria were not complied with and were not really enforced. That's certainly the case for government finance and also for the so-called real exchange rate criterion, which basically says that you should not have a process as a country in which your competitiveness deteriorates too much over time. Second, so that's the first process, and it's basically, if you look at the nature of what has happened there, that's more of a political issue. Why didn't that happen? There was no peer pressure as was supposed in the Maastricht Treaty. It was rather peer support among ministers of finance who have to ensure that the criteria are complied with. So it's more a political thing rather than a pure economic thing. The second element is the strongly asymmetric shock as a result of the worldwide financial crisis. This was really a very strongly asymmetric shock, affecting some countries far more than others. If you look at Spain and Ireland and you compare, for instance, to Germany, Germany didn't have a financial crisis at all, a little bit exaggerated, whereas those two other countries that I mentioned had a strong boom-bust cycle. It was an asymmetric shock to the euro area, a very strong asymmetric shock, the biggest financial crisis since 80 years, and that caused a lot of divergence in the euro area. And that meant that the criteria for the common monetary policy were clearly no longer fulfilled. So that means that the ECB has to act as a common central bank in an environment in which the criteria for being able to do so are no longer met, are no longer achieved. So that's why I've put on the sheet here that the ECB can also be seen as a victim of the crisis. So the diagnosis, to say that, is a combination of, on the one hand, a political issue, a governance issue of the euro area. Secondly, a financial crisis that was broader than a crisis just in the euro area that triggered strong divergences. And I think the euro crisis proper, is the difficulty of the euro area as a body, as it were, to deal with that. And I think that made the follow-up of the crisis more difficult in the euro area than in other countries. What has happened in the meantime? The operational framework, as it was used, has been adapted. I have a list here on the sheet of all the changes that were made. I don't go through them. You all know them probably. Perhaps more important is that in the meantime the interest rate has been reduced to zero, or a little bit below zero even. Standard monetary policy using that short-term interest rate as foreseen in the operational framework as it was defined originally has become ineffective, and most importantly, in the early stages of the crisis, the ECB could still argue whatever is the case, but we have achieved price stability. I recall that Jean-Claude Trichet, the previous president of the ECB, very much quoted or used the average inflation rate of the euro area since its inception, and that was all the time exactly as the ECB had defined price stability, very close to 2%. That has now changed recently. Euro area inflation is for the euro area as a whole it's not deflation, it's lowflation, you can call it. The latest figure is 0.4%, but that's clearly not close to 2%. And there, of course, there are also deflation in certain countries in the euro area, Greece among them. Now the point is that, of course, the ECB can only influence the average inflation rate, but as I said, that is too low at the moment, and that presents an issue for the ECB. It doesn't meet its own primary objective at the moment. So forget about all the problems that we have in the euro area and countries with all kinds of other issues, of course. The ECB doesn't meet its own objective at the moment. And there's also what I would call a spread problem, which is that inflation in Southern Europe or in countries with an adjustment program or adjustment process should be below the objective. It clearly is. And in the other countries, it should be above if your objective remains that you should have this around 2% or close to 2%. And that's not always the case. For Germany, you could argue that it is somewhat above the average. I think the latest figure there is 0.8%. But for instance, in the Netherlands, my country, we are exactly on the average. So there's not only a problem with the average level, which is too low, but the composition below that, around that average, is also not right. And the problem for the ECB is that the ECB cannot do anything about that second problem. It can only try to increase the average. So that's where the ECB stands. So the ECB is in a difficult position because it no longer meets its own objective in this crisis. So what can be done? What can be done? And I've called the title of my introduction the ECB between a rock and a hard place. The rock is that the ECB doesn't meet its own objective. The hard place, as we will see, is that it is not. There are no simple solutions to this problem of not meeting its own objective. So the first thing that can be done and is being done already is to go to non-standard measures and to extend those standard measures, meaning that the ECB starts to buy all kinds of assets, so interferes far deeper in markets than it ever intended, let's say, in its original setup. It can, and it does, prepare quantitative easing, meaning that the ECB could also start at some point to buy government bonds in a situation that the current policies don't have sufficient impact. And I've been rather modest in putting here on the sheet, it cannot be excluded that recent measures will not work sufficiently. I think it's quite likely that they will not work sufficiently if you look at it again from the perspective that the ECB in the end want to achieve higher inflation with these measures. And it may well be that quantitative easing may also not solve it. So the measures, let me put it more generally, the thing that the ECB can do itself are at best not very effective. Maybe not effective at all, and maybe, and that's my next point, and maybe they may also be counterproductive. They can lead to the formation of bubbles because these measures stimulate, let's say, the financial sector relatively strongly, and may well be too strongly in the end. They hamper and even destroy market functioning. The ECB, for instance, starts to buy assets related to the housing markets, so replaces the private sector in doing that. These measures also change the incentives for and market behavior of financial institutions. And let me put it a little bit provocatively and a little bit bluntly. If you look at financial analysts at the moment, they are very much concerned with if and when Mario Draghi will start to buy which assets and how you can position your institution to benefit from such asset buying by the ECB. So instead of focusing on whether investment in a certain firm, A, B, or C, is interesting, is useful, is attractive, there's very much emphasis on reflecting on what the ECB will do, and not on what whether certain firms or other assets are worth investing in from the inherent quality of those assets. Then and this is a more general point. No, let me first make another disadvantage not mentioned on the sheet. I've 3 in addition to the ones that I have here. That's the point is with these low interest rates and trying to push them lower and lower across the board. Of course, you heard the savers. They pay the price, and in some countries, again in my own country, where you have fully funded pension systems, the pension it's very difficult to fund your pensions. It may well be that people start to save more because they would like to hold on to a certain level of their pension, and they started to spend more. What is the intention of the policy? It may be counterproductive. Then a 5th problem, and I can only raise it as a question and as a kind of a hypothesis because it's a far broader point, and it's related to monetary policy in general. The question is: do we by these policies, by all the time trying to push lower interest rate, do we strengthen the growth potential or do we weaken it in the end? And of course, the idea is to strengthen it, to make investing more attractive. But it may well be that it is the other way. It's the other way around. And I said this is a more general problem. I cannot elaborate too much. We can discuss it further during discussion if people like. But very broadly and incompletely, what I think might have happened over the past decades is that monetary policy, first of all, has become very much focused on the financial sector and financial markets, and has become asymmetric, which means that at the moment that financial markets are booming, monetary policy stays quiet, is not tightened very strongly, if at all, and at the moment that financial markets get into trouble, you get a very rapid reduction in interest rates. That started more or less with the Greenspan era in the Fed in the midst of the 1980s, but it's, I think, the type of monetary policy that we have seen very broadly. That means that you have had a on-trend declining interest rate. And this has been very profitable for financial institutions, because you have very high returns and very high expected returns if you can assume that this process continues. If that's the case, it makes investing in physical assets less attractive, and everything is focused on easy profits in the financial sector. This is more of a hypothesis than that there is strong evidence, but I have been very recently referred to a working paper of my former colleagues at the Dutch Central Bank under the title "Low Real Rates as Driver of Secular Stagnation, Empirical Assessment." And I've not yet read the paper, but what they claim is that they indeed can find for Japan in particular that the all the time lower interest rate and very low interest rate was counterproductive in terms of stimulating potential growth. Finally, these policies may increase the inequality of the wealth distribution. So what can be done as alternative things? The ECB could announce that it is unable to deliver price stability as long as the underlying problems have not been tackled, and not go further into these non-standard policies. In line with that, and perhaps in combination with that, you could also argue that said the criteria for one common monetary policy do not exist at the moment. That what is needed for the euro area as a whole is a renewed convergence process, and that is, by definition and by nature, it will be a very lengthy process. That you, in the context of that process, redefine price stability and do not take into account lower inflation, as far as that is the result of countries having to restore their competitiveness. Fourthly, you can emphasize the necessary support of other policies, and that is what the ECB already does. The ECB, they're mainly focusing on structural reforms, as said, that's nothing new, and also fiscal policies. The ECB, of course, emphasizes very much that fiscal policy has to be within the framework of the Adapted Stability and Growth Pact, but you could, of course, also consider not only using maximum flexibility within the Stability and Growth Pact, but also relaxing the rules. Personally, I understand that there is some resistance to that road and that option in the core countries, because not the least in the core countries, you have in many cases very big governments with too high taxes, hampering growth rather than stimulating it. Then what is not what has not been mentioned very often until quite recently, and I think is very important, is the role of wage policies, trying to promote higher nominal wages in the core countries. That's not easy to achieve. The new Keynesian model does not really provide an analytical framework that enables thinking about it. But still, I think this is completely in line with the traditional thinking behind the ECB monetary policy framework. And the interesting thing is that Jens Weidmann, the governor of the Bundesbank, has started to indeed argue for higher nominal wages in Germany. And I think that's something that should be pursued and I think supported. Longer term, I think we need a redefinition of the monetary policy framework. That is not exclusively a euro area issue in my view. I hinted at the problems that I've seen with the monetary policy as it has been conducted in the past. I think one thing that should seriously be considered, without mentioning a number of other things, a central thing, I think one of the problems with the monetary policy frameworks of targeting consumer price inflation is that with hindsight, you could argue that we really have defined inflation too narrowly. We have not made sufficient distinction in our capital between different types of capital. Productive capital, which helps you to grow faster and to produce other capital goods or consumption goods. Financial assets and durable consumption assets. And I think more and more that houses should be seen as durable consumption assets, and should have been taken in the consumer price index. If we would have done that, it would be a very interesting exercise. If the period since the introduction of inflation targeting in the late 80s, which had been called the Great Moderation, still would have been called that way, because the housing market boom would have influenced the consumer price index. Interest rates would have been higher. The path of interest rates would have been different. It's very difficult to say what that would have been, what that would have meant, whether we could have avoided altogether the boom. I don't know, but it could have made a huge difference, and it's important to have this item on the agenda, because the discussion in the international policy arena is that what we have learned is that monetary policy alone can ensure price stability, but not financial stability, and therefore we need an additional set of policies called macroprudential policies. And these macroprudential policies now, for a large part, focus on directly targeting the housing market. And that may well be overburdening those policies. So if you could shift part of the burden to monetary policy, that may in the end be a good thing. There is an issue for the ECB but that's still somewhat away in time, I would say. But how to exit the current non-framework? I think, again, this is a more general issue. There was a well-defined framework, not only for monetary policy, but more generally for financial, budgetary, economic policy before the crisis that lies in tatters, and we are now in a kind of an ad hoc regime. It's unclear how to exit it and where to exit to at the moment. Thank you for your attention. I think try to put very many issues on the table very quickly. Sorry.
Thank you, Professor. I really have lots of questions, but I will keep them for later. Now, Professor Mario Tonveronachi, Professor of Financial Systems at the University of Siena, will explain us how to make the ECB a central bank of a non-federal state.
Thank you. I've changed a bit the title. You see, that is non-federal coalition of states. I think this is a better picture than union or state. Okay. Now it's after the crisis, normal opinion is that the design of the euro area is incomplete because it lacks the political part of the union. The problem is that we are more than 20 years after the Maastricht Treaty, and now the political unification appears more distant in the future than it appeared when the Maastricht Treaty was signed. And more than that, the present crisis did not only produce what is normally called the fragmentation of the economy and financial markets inside the area, but also has produced political fragmentation. So this makes even more difficult to think in the future of some degree, a sensible degree of political union. So if this is true, we must consider that the design that we have of the euro area is just inconsistent. And I propose two types of inconsistencies. We have the ECB, the European Central Bank, that is a central bank that is modeled as it should serve a federal state, but is serving a non-federal coalition of states. The second inconsistency is that we have on one side the goal to build a single monetary and financial market, besides the single markets for goods, capital, and so on. But on the other side, we have the absence of a common set of risk-free assets. Let's look at the first inconsistency. The ECB is the only central bank in the developed world that relies only on banks to manage liquidity. This means that it leaves the private system to determine the size of its balance sheet, net of bank deposit as central bank. As we saw after the increase in the balance sheets of the ECB in 2012, afterwards the banks decided autonomously how to redeposit this money at the central bank, how much to use and when, and how much to give back to the central bank. So despite the chart of the ECB allow the ECB to use open market operation in theory as a standard tool of monetary policy, in reality we have political and ideological problems that de facto impede the use of this type of policies. Because on one side we have the guardians of the treaty that says that if the ECB buys sovereign bonds, it produces sovereign moral hazard and fiscal transfers. The famous OMT was born dead and was just an open-mouth operation. According to the guardians of the ECB's capital, the ECB should only buy high-quality financial assets, otherwise it would become a bad bank. But the problem is that in the euro area we have not enough of this type of assets to make sensible open market operations. So the result is the ECB may come, perhaps, they are telling us now, to adopt some unorthodox policies, but this means that it comes to adopt these policies only when disasters looms. This means too late, and in general with interventions that are too limited in size. Let's look at the other inconsistency that concern the working of the single financial market. Normally, also in the official papers, declarations, we read that the crisis has fragmented the euro area financial market. In reality, it was not fragmentation, because we had not before the crisis really integration. We only had convergence, and convergence is fragile. Okay, so when something happens, convergence disappears, goes away, as we saw, and no type of fiscal rules like the fiscal compact can produce integration. They can only produce convergence, then a fragile situation. What a single financial market really needs is a single, unique issuer of risk-free assets. Because these risk-free assets, common to all financial intermediaries, not only banks, to all financial intermediaries in the area, are necessary for efficient market pricing. For instance, for pricing liquidity, the famous yield curve, and as the favored way to keep liquidity buffers and to post collaterals in financial transactions. So, since we have not this single risk issuer, local financial conditions remain linked to local sovereign. So, as we have seen, when sovereign drift apart, local finance follow. What were the reactions? One of the reactions was, okay, let's invent these new things, the banking union. And many people also of the European Central Bank told us that the banking union would defragment the financial market in the euro area. True, the banking union is a necessary condition to have a single financial market, but it is not a sufficient one. At best, although it's not sure with the present design, it might avoid that banks affect public finance, but the reverse is not true. I mean, with the banking union, we will not see enough of the effect on on national sovereign on financial conditions. And if we look at the recent comprehensive assessment made by the ECB and EBA, they applied heterogeneous haircuts to sovereign bonds held by the banks. And it seems as after some pressure of the president of the Bundesbank, also the ECB now is adopting different haircuts for normal refinancing operations. This means that the same ECB is recognizing that it is dealing with a fragmented, structurally a fragmented financial system. I advance a proposal that look at the political framework as it is. I mean, I'm not proposing to change treaties. I'm not proposing to change the chart of the ECB. Obviously, I'm not dealing with the problems of sovereign debt, of the deflationary nature of fiscal rules. I only look at the structural condition that we need to have a single financial market when we have not a single sovereign issuer. My proposal is rather simple. The ECB would emit debt certificates covering the entire maturity spectrum of a normal yield curve. I adopt the name debt certificates because this type of instruments are already present in the liability side of the financial operations, in the liability side of the financial operations of the ECB. They were never used, but they are there. The ECB would balance this emission with the acquisition in the secondary markets of sovereign bonds of the euro area in proportion of each country contribution to its capital. So you have on one side these debt certificates along a large type of maturity, and on the other side of the balance sheet of the ECB, these sovereign bonds acquired in the secondary market. The ECB then would not more accept sovereign bonds for its refinancing operation, but only its own debt certificates. This would push financial intermediaries to exchange sovereign bonds held for liquidity reasons, those that in the balance sheet appear as available for sale, exchange them with these debt certificates. To limit the role of the DCs to their liquidity function inside the euro area, only financial operators incorporated as firms in the area could hold and trade them. It is because these debt certificates must serve as benchmark, as I said before, and for liquidity management in the euro area, not for investment purposes. So we could have, at the end, a secondary market for these certificates, and the ECB could use these secondary markets for its open market operation all over the entire spectrum of the maturity spectrum. What could be the effect of this reform? Well, if the ECB, as it seems, is credible against fighting inflation, against inflation, these liabilities, these certificates, would be perfectly credit risk-free. In this sense, we could create a new type of seigniorage, because the balance sheet would have on the asset side a portfolio of sovereign bonds that would have a return that is higher than the average cost of the emission of DCs. So we could have a second type of seigniorage that could be, as the first type of seigniorage is, paid back to the countries that participate in the ECB capital, and in this sense we could have a positive moral hazard, because the country more with a higher rating, so with a lower debt and so on, would gain more than the others from this paying back of seigniorage. The financial operators all over the area would face a single risk-free yield curve and a highly liquid DC market, which would disconnect their funding cost from local sovereign, obviously not from local economies, because this is different things. I mean, if Deutsche Bank comes to work here in Greece, it would be subject to the same problems as a Greek bank, but not because it has problem of funding with the central bank. The ECB could operate full-fledged open market operation in certificates along the entire spectrum of maturities, not just short-term repos operation, as it is currently obliged to do, in order not to influence the markets of national sovereign debt. Because one of the great problems of this operation that were made in the past, but we are discussing if it will ever make these outright monetary transactions, is the extent to which the central bank can make this operation, because they are obviously going to affect the spreads of this treasury with respect to the bond. What is the concept on applying this type of operation? How much it must affect this spread? The German authorities say, well, they would go against the operation of the markets. Well, I am not so keen to accept that the markets are always right, but I mean, there is a high degree of discretion in this type of operation by the central bank. And this obviously is a problem if you look at the treaties. So, I mean, with this proposal that I explained to you, the ECB would not have this problem because the acquisition of sovereign and the production of certificates would only made for liquidity reasons, just to manage the liquidity problems of the area. Is this proposal complying with the treaties? Yes, because the acquisition of bonds in the secondary markets is permitted by the letter of the treaties, but more than that, acquiring these bonds for managing the liquidity of the euro area would comply with the spirit of the Maastricht Treaty because it is a necessary tool for the working of the single financial market. The second point is that, as I said before, if you look at the balance sheet of the ECB, in the liability side, you see that you have this debt certificate amount issued 0. Okay? Well, they are described as part of structural intervention for open market operations, but they were never used. In the treaties, in the chart of the ECB, you find no limits to the amount and the type of certificates that they can emit. So, I mean, there is no formal clause that against this type of proposal. The last problem, political problem, obviously, that could be advanced objecting to this proposal is, okay, but having sovereign as assets, if you have some restructuring of debt, some failure of sovereign debt, this means that the ECB would lose capital, okay? Now, the funny thing is that a central bank that is emitting paper money is considered as, in the old time, a central bank that was emitting convertible money during the gold standard. So it is treated like a normal bank, okay? It has assets, liability, the difference is capital, okay? But the problem is that the liabilities are irredeemable money. So this means that they are not a real liability. Which means that if, as we always make our calculation, what is the capital of a bank? Well, if we do not look at the balance sheet, but we make some forward-looking statement, as Minsky told us that it should be our methodology to look at the fragility of a position. Well, if we look at the central bank in this way, it has a seigniorage in the future that is always positive. It means that its capital is always positive. A central bank is, by definition, in a Minsky hedge position. This is the same thing for my proposal. This second type of seigniorage that would be created has the same characteristic of the other one. I mean, it has on the asset side a portfolio that normally, in the long run, is going to give a return that is always higher than the cost of the liabilities. This means that also in this case we have no problems. The problem is that you have not to look at the value of the assets, but on the stream of the flows in Minsky term. So, if at the end our orthodox friend must be in some sense placated, well, we can in the first years accumulate the second type of seigniorage in a fund that would serve as a reserve against eventual restructuring of public debts. Okay, thank you very much.
Thank you, sir. We have some time for discussion. And obviously, I'm going to abuse my place as moderator to ask the first questions. So, Emilios, on your presentation, you talked a bit about the differences in tax rates, and I wonder if you could elaborate on that, because your suggestion is basically to build to construct a euro area treasury, but perhaps streamlining tax rates and VAT rates wouldn't have, well, sort of the same positive effect in fixing these internal market anomalies that you described, and smoothen the shocks from sudden capital flight. I know this is ambitious, like streamlining of tax rates, but it certainly sounds as less ambitious as creating a pan-European treasury. And well, the two of you, if I understood correctly, you said that basically the way things stand now, the ECB can't do much, and Lex, you suggested that they go out and admit it, and Super Mario, instead of going out and saying, "Hi, I'm Super Mario, I can do whatever it takes," that he should admit that he cannot do anything. So I take it that you both think that the recent decisions by the Governing Council regarding ABS and covered bond purchases are doomed to fail, because the ECB has said, give it some time, we'll see how it goes, and then we'll consider doing more. But if I understood your presentation correctly, you give these decisions no chance of succeeding. Thank you.
Thanks very much. That's a very interesting and challenging question. I think as things stand with tax arbitrage and tax competition between member states, we are in an environment of de facto trade barriers. However, I do not advocate tax harmonization. I advocate a common treasury for the reasons that the previous speaker mentioned as well. We need a single risk-free asset in order to integrate properly the European financial system. So what I envisage is that the common European treasury would issue its own bonds that would absorb to some extent interest rate shocks, especially debt refinancing shocks throughout the Eurozone, and even more importantly, will provide a fiscal backstop, a credible fiscal backstop for the European Banking Union. The United States has a common treasury, yet there is lots of tax competition between the different member states. I do not envisage a common European treasury, a common Eurozone treasury, as a way to ameliorate tax arbitrage. Not at all. I think tax arbitrage is a good thing, provided, however, that it's not a gross barrier to internal trade. It's not an insurmountable barrier to internal trade.
I can be very brief on the answer to your question. That's yes, you understood very correctly what I try to convey. But perhaps I can elaborate a little bit more on debt mutualization and that type of things. I look at the situation we are in, as I said in my introduction, my presentation. We have to start, in my view, from the current framework as it is. And if I look broader, so that's the Maastricht Treaty. I'm not just referring to monetary policy, but more broadly. That's the Maastricht Treaty and the changes, let's say, that have been made over the past few years. Now, so the question is where to go from here, and I think you have to make a distinction between, on the one hand, what should be the end regime, and there let's say, one of the discussions is, should you move towards political union? Now, that's in terms of, let's say, a regime where you would have a solid monetary union. It's a no-brainer, it would work. The only problem there is that politically it's not very likely that you will get a lot of support from it. So I think you have to think further whether there are regimes that are not a political union, but still would provide a solid monetary union. So, but that's the first question: what type of regime do you want to go to, or do you want to move to? But secondly, I think we have to go through a renewed convergence process, as I said. At the moment, the criteria are simply not met, and so you have to go back to a situation where that is the case. Now, on debt mutualization, I must say I have been for quite some time been an advocate of supporting the proposal by the Dutch wise men and women. Peter Bovinger is here tomorrow. I don't know whether he's here already, but he was one of the people making that proposal. I found it an interesting proposal. I was on a committee of the European Commission looking at that proposal. For me, it was something that could be done if it would be linked to, let's say, a stronger assurance that the adjustment process is complied with. So there could be a kind of a compromise between, let's say, Germany or the northern countries, however you call it, who would accept mutualization, and the southern countries, periphery, however you call it, who would commit themselves to a realistic convergence process over quite a number of years, with a stronger role for the European Commission or a European Minister of Finance to ensure that indeed the process would really follow the path. Now, the problem with the debt mutualization is that it is legally not possible to really have a debt redemption fund without changing the treaty. And then you already have something to think about it, because then it cannot happen very quickly. It will have all kinds of other complications. And secondly, in the meantime, by having the OMT, the interest rate spread problem, at least in the area of government bonds, has been reduced quite strongly. So what you could do in the shorter term, perhaps, it's not even legally certain, to set up a debt redemption fund where you do not have a full mutualization in the sense of joint and several guarantees, but partial guarantees. Problem is that then the interest rate reduction, the interest rate benefit would be even smaller, and not worth all the deals I would all the things I would say. Final thing I would like to say is on the issue of risk-free assets and central bank capital. I think this if you follow my approach to solving the problem, is what by renewed convergence you would recreate fiscal sustainability in all the countries that are part of the euro area, and their assets would become risk-free assets once again. So that's another way to create the risk-free assets, rather than starting from the problem that we have, assuming that you don't solve that problem, and creating risk-free assets in another way. Then on central bank capital, I must say I see the logic of the arguments that central bank capital is either always positive or doesn't matter. It's also a point that is made. I'm very cautious there, because that assumes that indeed, as also mentioned in the sheets, that the central bank is able to maintain price stability. And then you could say, well, it doesn't matter. But if the things are endogenous, if you have a central bank that has the power and the will to issue as many certificates as it likes, at some point, people may start to doubt the credibility of the central bank. So I'm very cautious with having no restriction at all on central bank behavior, because that could trigger all kinds of wrong policies in the end. Let's say all the arguments that it is in line with the treaty, the ECB can issue. That's all true. That can be done, but I wouldn't like to see it, because as I said, it starts at the wrong end, in my view, and may undermine the credibility of the central bank. Not immediately, but over time. You create a wrong regime.
Sorry, can I just add something? I mean, my understanding is that you have a quite pessimistic view on, how effective can the ECB be, and you also cited Japan's example of, like, a case of a super accommodative monetary policy failing to achieve the desired results. But there are also, like the US, examples of, super accommodative monetary policy achieving its targets. So there are also best practices.
First of all, I don't want to be pessimistic at all, and I'm not pessimistic about, let's say, the further future of the euro area. I was focusing on the role of the ECB in meeting its own objective and having the instruments available in the current juncture of doing that, given that the ECB doesn't meet its own objective at the moment. That's where I'm pessimistic about. I don't think that, let's say, the things that have to be done to restore a viable monetary union are things that have to be done by the ECB. These are things that are most of them are outside of the mandate of the ECB. Let me say, I think what is needed is this reconvergence process. I think you need at least to considering restructuring of the private sector SMEs. The problem of SMEs in many cases is not that they have not enough debt on their balance sheet, that they have too much debt on their balance sheet. They need more equity, more risk-bearing financing. Now, what is the TLTRO doing? The main element in the ECB is it's trying to increase credit to those sectors, which may in the end either it will not flow, because the SMEs do not need debt but equity, or it will re-leverage a sector that is in many cases already over-leveraged. So my point is not being pessimistic. I'm just looking at the role of the ECB, and we should look more at the ECB of how it can do its own task in a framework in which there are the conditions for the ECB doing that are no longer fulfilled, rather than trying to find a solution to the overall problems via the ECB.
Emilios, you want to ask Mario a question?
Yes, I have to admit that while I was listening to Mario's presentation, I was thinking, damn, I should have been the discussant in that paper. It sounded that interesting. And it sounded that interesting because I think it's a very innovative idea about creating a risk-free asset, and I like the fact that it's like emission allowances, talking about disseminating liquidity without necessarily increasing leverage, because obviously these guys would have a different kind of asset, sovereign bonds, they would liquidate them to get the liquidity certificates. And as a matter of fact, as a lawyer, among other things, I think it wouldn't fall foul of the no bailout clause because no debt is cancelled. I'm not sure about the no monetary refinancing. However, I do see three insurmountable structural problems, and I think I wouldn't be honest to myself if I didn't raise the question, even though I was fascinated by the paper and the idea. How do you restrict their circulation between the ECB closed trading system, closed refinancing system? How do you restrict the secondary market in an open market environment? When you liquidate sovereign bonds in order to get liquidity emission allowances, certificates, do you affect the refinancing costs of sovereign debt or not? How can you structurally deal with the fact that you generate liquidity? I don't think you increase leverage. It's a very ingenious idea that increases liquidity without increasing leverage. However, how do you make it sure that that liquidity is either not hoarded, as it happens today, or exported, because what we fundamentally face in the Eurozone is a systemic crisis of confidence to the Eurozone economies, and as a result, all capital flows in the past 3 years have been negative. The Eurozone is exporting much more capital than is importing because it has lost the confidence of global investors. So I wonder, how would you deal with these fundamentally challenging and probably insurmountable problems?
Well, first of all, I think that we should completely separate the issues of problems relating to solving or treating, in some sense, the sovereign debt problem with monetary policy and ECB. If we try to tackle the two problems together, my opinion is that we always find political problems. We have other proposals, like by Brunner and recently by Lucrezia Reiklin, that goes on mixing the two problems. I think that we should separate the two things. And looking at the monetary policy in the euro area as a singularity. Is a singularity that political construction. It's a very different political structure from what we have in other parts. But we have a central bank that was designed on the Bundesbank design, but cannot do what the Bundesbank did when it was the central bank of Germany. So the problem is we have an inconsistent design. Okay, our problem is, do we think that we will reach in our lives a political union? My answer is no. Then we go with this inconsistency, or we try to model the central bank to this coalition of states. I continue not to use the term union, okay? My proposal is in these terms. I mean, we must invent a different central bank from the Federal Reserve, from the Bank of Japan, from the Bank of England, and so on, because we have a different structural situation. But we need, if we need, a single financial market, that's the problem, okay? The problem is, do we need it? If the answer is yes, we need it, then my answer is, okay, the only way is that the central bank does what a central government normally does, emitting risk-free assets. I don't see why we should have problems of this central bank emitting quantities without limits of these debt certificates, because it's a normal problem of how with other central banks they manage the liquidity of their system. Why should we have some different problems from, from the others? I do understand that this type of super liquidity operation cannot have many results. What I am looking at are the structural conditions for the operation of monetary policy in the euro area that would work in normal times, not just to meet problems when we have big crisis and so on. In normal times, we need a different central bank because we are in a very peculiar political construction. Finally, obviously the operations of liquidity, which means that in a certain sense you buy and also you intervene in the secondary markets of sovereign bonds, you can affect the returns of sovereign bonds. But so does the Federal Reserve, so does the Bank of Japan, so does the Bank of England. Where is the problem?
Right. Now we have a few minutes for questions from you guys. I apologize in advance. I can't see you very well. These lights are very strong. I feel I'm in an interrogation room. So I think, yeah.
Καϊμάκης Νικόλαος από το Τμήμα Ευρωπαϊκής Πολιτικής του ΣΥΡΙΖΑ. Έχουμε αυτή τη στιγμή, από ό,τι κατάλαβα από την πολύ ενδιαφέρουσα συζήτηση, έχουμε δύο ιδιόμορφα μορφώματα στην Ευρωπαϊκή Ένωση. Το ένα είναι το πολιτικό, που παρουσιάζει ελλείμματα και ανισορροπίες σχετικά με ένα όρομα, ενοποίησης. Και το άλλο είναι το τεχνοκρατικό, το οικονομικό, όπου και εκεί παρουσιάζονται ιδιομορφίες, ελλείψεις. Απόδειξη ότι ούτε το ένα προχωράει, ούτε το άλλο μπορεί να ρυθμίσει τα ελλείμματα και τα μικρά βήματα. Δηλαδή η θεωρία των μικρών βημάτων για την πορεία της ενοποίησης της Ευρώπης φαίνεται ότι από εδώ και πέρα δεν πάει. Ο Μονέ μέχρι τώρα οραματικά δούλεψε. Από εδώ και πέρα δεν δουλεύει. Και το ερώτημα για τους έκριτους ομιλητάς είναι δυνατόν αυτές οι δύο ανισορροπίες να διατηρήσουν αυτό το μη ομοσπονδιακό μοντέλο ή χρειάζεται μια βαθιά πολιτική και οικονομική τομή και μπορεί να γίνει με τους σχετισμούς και κυρίως με το νεοφιλελεύθερο αφήγημα το οποίο είναι πανίσχυρο σε αυτή την περίοδο με σταθερό υποστηριχτή το χρηματοοικονομικό πεδίο και με την κοινωνία και τις κοινωνίες της Ευρώπης στη γωνία με ένα βασικό έλλειμμα δημοκρατίας. Αυτό είναι το ερώτημά μου.
Correct me if I mistranslate the question. So the gentleman who
I heard a translation.
Okay.
I think that's a very interesting question. As far as I'm concerned, I have provided both a critique of the neoliberal model and of the current structure of the Eurozone. That's why I proposed a plan for limited debt mutualization and for a European Treasury, which does not necessarily entail a political union. Without those two, of course, we are in a limb. I have to say here that indeed the neoclassical model of growth has lots of inherent, is riddled with inherent paradoxes and so on. But as far as I'm concerned, and I'm not a neoliberal, I do not know any other credible model of economic growth beyond the neoclassical. So we should be careful what we argue for, because there are issues of limitation as to whether we can implement it. I close the parenthesis in order to say that in the absence of structural interventions in the way the architecture of the monetary union stands today, the only alternative to bridge the gap provisionally and until we move to radical architectural changes is the ECB. And as a result, I agree with Mario that the central banks, today's the central bank's balance sheet is always positive. However, we should be careful there as well, because we do not know how positive. We are no longer in the period of metallic coins, where we knew on the basis of circulation of metallic coins and the difference between face value and the real value of the base metal, how much was the seigniorage. And also, the central banks today are not the only money creators. There are massive money creators out there which generate liquidity, and these liquidity flows have nothing to do with the central bank. I mean the shadow banking operators that create short-term liabilities that are exactly like money. However, in the absence of any willingness to move to structural reforms of the banking union architecture, the only hope left is using properly the ECB balance sheet.
Let me start again from, let's say, the analysis of this crisis, and then also responding a little bit to the issue of the design of the Maastricht Treaty. Are we in this crisis because of an inconsistency or inconsistencies in the design of the Maastricht Treaty? My view that it is not the case. By and large, I think it is the Maastricht Treaty was not a bad treaty. Perhaps we should have had a banking union from the beginning. But the rules of the game, as described in the Maastricht Treaty, are not bad, and I think are a sufficient basis for the future. Would a political union, let's say, be sufficient for solving, let's say, the problems? Yes, but I fully agree that it's not very likely that in the short, medium, and even longer term that we can expect such a monetary political union to form. What is the basis of the problems? I think, first of all, not complying with the rules that were in the Maastricht Treaty during the period before the financial crisis, but perhaps not that was not even a very big thing. Then we got this huge asymmetric shock, and you could also turn it around. It's surprising that the monetary union survived such a big shock, such a young monetary union. That's you could also see as evidence that the rules of the games are not that bad. That drove apart, let's say, the countries, and then it became clear that it is difficult, but mainly for political reasons, to commit yourself to at least that was the perception, to the euro and to the rules and to what is necessary. So what I think is I think there is no reason to completely overhaul the rules of the game. A banking union is now in the process of being set up. It's imperfect. It can be. It should be worked on further. There have been changes to the governance framework already. One approach would be to say, well, okay, for the moment we have changed a number of things. Let's see how it works out. The most important thing is the second part of solving the divergence. Let's see how the new rules work out in practice. Let's streamline them, because it is we have a very complicated structure, which is a problem in itself, I would say. Streamline it, and at some point perhaps bring it into the treaty, so that we have a common framework again. if you want to go further, then certainly I think there's no appetite for a full political union. What you could try to do is to give somewhat more power to the center, and if you were considered to do that, for me that would then be that the center gets more power to ensure that the rules of the game are complied with.
I think that we should separate from what it would be necessary for the result and what we can get. I mean, we know what is now the political situation in Europe. And we can only hope to try to find something to weaken our problems and rebuild some confidence among the member states. But obviously we have. I do not agree that the Maastricht Treaty was more or less a good project, because it was a neoliberal project, okay? Because the markets were the ones that had to work and produce what? Convergence, a single market. It was all the free markets that were to make this type of to give this type of result, not the authorities. What have made the authorities? Have created a legal framework in which the market should have produced these results. Look at, for instance, all the framework of regulation, financial regulation, okay? But, okay, the results of creating of a single market was on the shoulder of the private markets. Okay, that was the neoliberal design. I mean, nothing. But how could we, in this situation, put the rules that were fixed in the Maastricht Treaty? They were insufficient because they did not look at the structural problems that the different countries had. It was not only a problem of inflation, debt, deficit. Otherwise, you are thinking that you are looking at some proxy variables of all the working of the economy. Again, a neoliberal theory. Okay? So, I mean, from my point of view, the Maastricht Treaty was not just a bad design, an incomplete design. It was a bad design because it was based on a wrong type of theory. It was based on what? Realpolitik, maybe. But many times realpolitik is not producing the best results. In our case, we have seen that the results were not, in many cases, acceptable. And all the political framework that was put under the aegis of the Maastricht Treaty was obviously a political framework where you had someone who who was more important than others. Obviously, it was in the structure of the treaty, because when you have losing the majority vote only at in a certain fields, but not on the fiscal side, this is the result that you have. When when Schäuble says, well, anyway, if the German Constitutional Court or the European Court says they can say whatever they want over the OMT, but since I am there to decide yes or no with a unanimous vote, you will not have my vote. That's the point. That's the system that was created under the Maastricht Treaty.
Okay, we have time for one more question, and then we can take it to the discussion to lunch. Yes, please.
My question is for Professor Hoogduin. You mentioned in your talk that QE, one of the disadvantages of QE is to create bubbles, and I was curious to hear what mechanism and under what conditions QE does create bubble, because I'm not convinced. And the second point is in your proposals, you mentioned redefining price stability might be one way to go. And if I understand you correctly, you're proposing redefining price stability to a higher rate. If that's what you mean, then it would be unclear to me what impact this may have if the president of the central bank in the press conference in September candidly admitted that in this situation, central bankers have no power to increase inflation. So no matter how you raise the target, that doesn't give more power to the ECB. Thank you.
Yeah, thank you for your questions. First of all, I'm very happy with the question on price stability because my intention is not at all to increase the target for price stability. I think the main asset of the ECB is that it has so far, until the past few years, it has delivered on its objective, and so the definition of what price stability is very important to me. Not to increase that. So my preference would be not to do anything at all, in combination with acknowledging that in the current environment, the instruments that you have for increasing inflation and getting back to your definition of price stability are not very effective, are not very efficient, while at the same time they have high risks attached to them. The proposal that I refer to as a possibility is that you would say, well, what we need is that in a number of countries, you would have for a number of years an inflation rate below the definition of price stability, because they have to gain competitiveness. Make an estimate of how much that would be, and correct the overall objective downward. If you wouldn't do that and really would go for the 2%, then that would mean that countries like Germany, the Netherlands, Austria would really should have an inflation well above 2%. And it's even more difficult to see how you can do that. The ECB can certainly not do that. Then you perhaps have to indeed then you have to have that wage policy or fiscal policy. But the room for maneuver for fiscal policy is there perhaps in Germany to some extent. But we should not and I'm perfectly happy with asking Germany to use that, and also having investment programs with all the caveats that I could mention. I'm completely in favor of that. But that will not easily increase inflation if you do not interfere directly more in the nominal wage part. QE. How it creates bubbles? Well, you provide a lot of liquidity. where financial market parties use that to buy all kinds of financial assets. In particular, if you, for instance, let me just give one example where you could at least ask questions at the current price levels. If I look at the development of the equity markets, again in the Netherlands, because I know the data there well, they have gone up quite strongly the past years, whereas the profits only go down. So there is a disconnect. There is a clear disconnect between, let's say, the financial prices and the underlying assets. And more generally, if I look at bond markets, at the interest rate levels that we currently have, perhaps you should not call it a bubble, but you are in a situation where there is a very skewed risk distribution in the longer term. If our policies are successful, they can only go up almost. And to see how that can be done without market turbulence is quite challenging, I would argue.
Okay, according to the schedule, we should break now.